Have you ever felt like the economy is playing a game you don't understand, where markets go up and down and everyone on TV speaks in confusing jargon? Well, the truth is, there is a hidden force behind it all. It's called liquidity cycle. Basically, how much money is flowing through the global system. And right now, that cycle is one of the biggest reasons stocks, real estate, and even Bitcoin are moving the way they are. Let me break it down for you in plain and simple English. So let's go. Okay, so what is this liquidity cycle? Imagine the financial world as a giant swimming pool. When central banks and governments add water, that's money and credit flowing into it, everyone in the pool can splash around, have fun, and asset prices like stocks, homes, crypto rise. But when they drain water out of the pool, things get dry, painful, and eventually markets sink. Right now, we are about 3 years into one of those fill-up phases. Money is flowing, and that's why markets feel stronger than many people expected. So what's driving it? So let's talk about that. The debt problem. Back in 2020, 2021, during COVID, governments and corporations borrowed trillions of dollars at almost zero interest rates. Now, these loans are coming due, but interest rates are way higher. So imagine taking a mortgage at 1% and now it is at 6% when you refinance it. Ouch. So us Canadians have lived through it for the last 5 years. Now it's governments and corporations feeling the pressure. To keep the system from breaking, the US Treasury is quietly pumping money back in by issuing short-term government bills. And commercial banks are buying them. And when they do, they print new money push into the system, right? So that's keeping liquidity in the system. It's like topping up the pool with a garden hose. And let's talk about China. Meanwhile, China has its own debt problems. And their solution? Same old, print money and push it into the economy. That extra cash spills into commodities like oil, metals, and also global markets. Now, you know that Trump administration wanted a weaker dollar, right? So the US would love a weaker dollar because it makes their exports cheaper and debt easier to pay. But because the US is still seen as safe haven, money from all over the world keeps rushing in, and that makes the dollar stronger than the US actually wants. Now, I get it. This sounds complicated, but this is exactly why I built my macro fundamentals course, to take these big global forces and show you how they actually affect your money. And if you want personal assistance, I offer one-to-one consulting calls where we can just sit down, discuss your portfolio, share some ideas, do some brainstorming, and I'll give you my opinion, what would I do if I was in your shoes? Not a financial advice, but just some discussion over a one-to-one conversation. So if you're interested, links in the description below and let me know how we can connect. Here's the good news. This liquidity cycle still has room to run. Most analysts expect it to keep going until early 2026. So in the near term, stocks, ETFs, even Bitcoin could be climbing up. But here is the bad news about that. All this extra money comes at a cost. Every time governments pump more liquidity into the system, they're actually watering down the value of your money. That's what inflation and currency debasement really means. And central banks know it too. For the first time since 1990s, foreign central banks now hold more gold than the US government bonds. They're hedging against the dollar. They're hedging against British pound, against euros, against Japanese yen, against every fiat currency. And Bitcoin, that's becoming another form of outside money that the governments cannot print. So here's the takeaway. The money taps are still open. The swimming pool is still filling. That means markets may still have fuel for now. But don't mistake that for safety. It just means you need to be invested wisely. That could mean broad market ETFs to ride the global wave, some gold, some Bitcoin to protect against the debased currency system, and yes, some cash on the side for when opportunities pop up. Because when the music eventually stops, and it will, those who did not prepare will be left standing without a chair. So are you staying invested through this liquidity wave, or are you holding back in fear of a crash? Drop your thoughts in the comment section. I would love to hear how you are playing it.